You know, Warren Buffett buys a stock with the intention of holding it for the rest of his life,
Mm.
like literally forever.
Right, yeah. That is the classic eternal buy and hold strategy.
Exactly. But then you have Stanley Druckenmiller. I mean, he's arguably one of the most successful macro investors in history, and he holds a stock for an average of just 8 months.
It's an incredible contrast, really the ultimate test of two completely opposing financial doctrines.
It really is. So today, for this deep dive, we are looking at Druckenmiller's actual, real-world $3.38 billion portfolio.
Yeah, we are pulling the 13F filings from his Duquesne family office, which reveals about 70 different reportable positions.
And our mission is to put his ruthless 8-month turnover strategy on trial against Buffett's rulebook. We'll call Druckenmiller's approach inflection alpha and pit it against Buffett's compounding safety.
I love that framing. We really want to see where they clash and, surprisingly, where they actually overlap.
Before we jump in to access more advanced research, companion for modern intelligent investors, and leverage our latest Deep Values agents, welcome to download Deep Values app from App Store. To track stock market temperature, welcome to download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
Perfect. So where do we start with these two?
Okay, let's unpack this, because before we even look at the actual stocks they're buying, we have to understand how totally different their brains work when they look at a business.
You really do. You can't just interpret Druckenmiller's filings without first totally abandoning the conventional wisdom of passive investing.
Yeah.
He operates in a completely different dimension of time and risk compared to the rest of the market.
Yeah, I was going through the source notes, and the best way I can visualize the difference is this. Warren Buffett is like a master shipbuilder.
Okay, a shipbuilder.
Right, he wants to construct an absolutely unsinkable vessel. So he looks for durable, competitive moats, highly predictable earnings, and these massive cash buffers in the hull.
Which makes sense. The goal is to set sail and just coast indefinitely, right? Just weathering any storm the market throws at him.
Exactly. His time frame is permanently indefinite. But Druckenmiller, he is not building a ship. He is an expert surfer.
Oh, that's a great way to put it.
He watches the horizon for central bank liquidity and these, 18 to 24-month macroeconomic turning points.
He's waiting for the right conditions.
Yeah. He paddles out, catches a massive disruptive wave, rides it for maximum speed, and then deliberately jumps off before the wave crashes on the shore.
What's fascinating here is how clearly that surfing mentality dictates his operational metrics. I mean, look at the structure of the Duquesne portfolio.
It's pretty wild, right?
It relies on extreme concentration. The top 10 holdings make up 55.6% of his reported assets.
Wait, over half the money in just 10 ideas.
Yeah, exactly. He is not interested in mimicking a diversified index fund at all. He concentrates capital entirely into his highest conviction ideas.
That requires so much confidence. But it's the movement of that money that really shocked me.
The velocity of his capital is just staggering. The portfolio has an annualized turnover rate of 58.06%.
So more than half of the entire multi-billion-dollar fund is being swapped out every single year.
Right. His average holding tenure across all positions is just 2.7 quarters.
Wow. So while Buffett buys a stock hoping his grandchildren will inherit it, Druckenmiller is rotating capital into a completely new idea in less than 9 months.
Exactly. He treats intellectual flexibility as a survival skill. He has zero psychological attachment to a company.
Which begs the question for you listening, why should you care about a billionaire trading stocks that fast?
It's a fair question.
Because it completely challenges the mainstream financial advice we're all fed. We're always told to just buy and hold.
Right, the classic retail advice.
But Druckenmiller's success proves that if you have ruthless intellectual flexibility, if you're willing to cut your losses, the absolute second the macroeconomic thesis changes, that is a highly viable alternative to sitting on a declining stock in the name of value compounding.
You don't have to be a shipbuilder if you know how to surf.
Exactly.
If the fundamental catalyst accelerating a stock's growth begins to stall, he sells. He does not care if he has to buy that same stock back next month at a higher price, provided the catalyst has reignited.
He is chasing the inflection point, not the bargain.
Yeah.
So let's see how these conflicting philosophies actually play out in the market right now.
Let's do it.
Starting with the biggest sector in the world, technology. Druckenmiller's recent tech pivot is drastic. He completely liquidated Alphabet, Google, and heavily trimmed Amazon.
Right, to pivot straight into the picks and shovels of AI infrastructure. We're talking semiconductors, power grids, data centers.
But I'm looking at Buffett's portfolio, and he loves a monopoly. He owns a massive chunk of Apple. Why wouldn't Buffett love the ultimate AI infrastructure companies?
It comes down to how each man defines predictability. Let's look at Taiwan Semiconductor Manufacturing Company, or TSM.
Okay, TSM.
Druckenmiller allocated nearly 5% of his portfolio to TSM. From a purely structural standpoint, TSM possesses one of the widest economic moats on Earth.
Because they produce virtually all the leading-edge sub-3 nanometer microchips.
Right, exactly. The ones required by Apple, NVIDIA, and AMD. A competitor literally cannot replicate their manufacturing process without hundreds of billions of dollars and decades of trial and error in metallurgy and physics.
They are the toll bridge for the entire digital economy,
Wow.
and the business math backs that up. I mean, TSM generates a 42.4% return on invested capital.
It's incredible.
For every dollar they put back into their factories, they're pulling out over 42 cents in pure profit. They throw off highly predictable free cash flow.
So on paper, this sounds like a Buffett dream stock.
Right. And Berkshire Hathaway actually did take a massive multi-billion-dollar position in TSM recently, but Buffett liquidated it almost immediately.
Yeah, he looked at the sovereign geopolitical tensions surrounding Taiwan and decided that despite the incredible business moat, the geographical risk destroyed his margin of safety.
Because if a blockade occurs, those factories just stop.
Exactly. Buffett wants a business that lets him sleep soundly at night for the next 10 years.
Meanwhile, Druckenmiller holds on to TSM
Yeah.
because he's surfing the wave.
He isn't worrying about the long-tail geopolitical risk of the 2030s because the technological inflection happening today is just too massive to ignore.
Right, the insatiable demand for AI hardware.
Yeah.
He's playing the 18 to 24-month catalyst.
That is the core distinction. Druckenmiller prices in the immediate reality over the distant hypothetical. And this divergence gets much more extreme when we look further down his tech infrastructure list.
Oh, yeah.
He bought into Bitcoin infrastructure operators like Bitdeer and Riot Platform.
Wait, I have to stop you there, because Buffett would run screaming from a crypto miner.
Oh, absolutely screaming.
I mean, look at the mechanics of those businesses. They possess zero economic moat. They operate commoditized power assets.
Yeah, and their cash flows are wildly unpredictable because they're tethered to cryptocurrency hash rates.
Exactly. Plus, they constantly dilute their own shareholders by issuing new stock just to fund their expensive data centers. So is Druckenmiller just making a backdoor bet on the price of Bitcoin going up?
That is the logical assumption, but he's actually looking past the crypto entirely.
Really?
Yeah, he's looking at the physical land and the power grid. He sees modular data centers that already have secured power contracts and transmission access.
Oh, I see. Because right now, access to gigawatts of electricity is the single massive bottleneck for AI development.
Exactly. He views these miners as physical infrastructure plays that can pivot to host high-performance AI computing workloads.
So he doesn't care that they lack a 20-year consumer brand moat.
Not at all. He cares that power is scarce today, and they have it.
Here's where it gets really interesting, though. If TSM is a partial overlap, where they at least agree the core business is good, Druckenmiller's massive allocation to biotechnology is where he takes Buffett's rule book, sets it on fire, and throws it out the window.
It is an absolute departure from traditional value investing.
Biotech and oncology diagnostics make up roughly 30 to 35% of Druckenmiller's entire portfolio.
That is a massive chunk.
And I want to push back on this strategy. Let's examine his biggest holding, Natera, ticker NTRA. It represents 18.14% of his reported portfolio.
We are talking about over $600 million in one single stock.
But look at the fundamentals. Natera has a negative return on equity of minus 12.2%. They generate negative GAAP profits.
Yeah, the numbers are brutal on paper.
And they're trading at an eye-watering 13.5 times enterprise value to sales. Let's translate that for a second. That means he's paying 13.5 times the amount of money Natera brings in at the top line. Not their profit, their raw revenue.
Right. While Buffett wants to buy a business for 10 times its actual tangible cash profit.
Exactly. Druckenmiller is paying a massive premium just for the sales, assuming the profit will magically appear years down the line. Isn't this just gambling on science experiments?
This raises an important question about how we define the timeline of value. Buffett demands a historical, proven margin of safety.
He wants to see the cash flow already arriving in the bank account.
Exactly. But what Druckenmiller is executing with Natera is the pure definition of inflection alpha.
Okay, map the mechanics of inflection alpha onto Natera for me. How does a money-losing company justify a $600 million bet?
So inflection alpha means identifying a moment where a company's business trajectory is about to bend sharply upward.
Like a hockey stick growth curve.
Yeah, usually because of a product adoption cycle before Wall Street fully prices in the resulting monopoly. Natera performs liquid biopsies, cell-free DNA testing that can spot cancer recurrence months before a traditional CT scan.
Okay, that's incredible technology.
It is. Their flagship test, Signatera, saw its clinical volumes jump 57% year over year. They're crossing 1 million test units a quarter.
So doctors are actually adopting the product at a massive scale.
hmm
The revenue is real.
Yes, the adoption is very real. And while the accounting shows a GAAP net loss because they are currently spending billions on research and massive sales teams to capture the market share.
Right, the upfront costs are huge.
Exactly. But their underlying unit economics are actually flipping positive. They recently generated over $100 million in free cash flow.
Oh, wow.
Druckenmiller sees this clinical adoption accelerating faster than the broader market realizes. He buys the inflection before the GAAP profits officially show up on a quarterly report.
Okay, that makes sense. And he's doing the exact same thing with Insmed, isn't he? That's his second biggest holding, sitting at nearly 5.6% of the portfolio.
He is. Insmed is a specialty pulmonary therapeutics company. They are currently burning through cash.
Sounds familiar.
Right. They hold a highly leveraged balance sheet loaded with debt and royalty financing, but they have a new drug for lung disease called Brinsupri.
And what's the projection on that?
Internal management is projecting peak enterprise sales to eventually exceed $14 billion.
$14 billion in potential revenue. But the key word is potential. It is entirely binary.
Highly binary.
It relies on regulatory approvals, clinical trials, and doctor adoption.
Which is the fundamental reason Buffett wouldn't touch it. Buffett wants predictable consumer habits, like people drinking Coca-Cola every day for 50 years.
Yeah, he abhors binary risk.
Druckenmiller, however, is willing to swallow a leveraged balance sheet and negative current earnings if the forward momentum, the clinical breakthrough, is strong enough to trigger a massive sudden re-rating of the stock price.
So Druckenmiller will buy profitless biotech, and Buffett only wants cash printing monopolies. You'd think their Venn diagram of investments is just two completely separate circles.
You really would.
But let's look at the exact center of that diagram. What does the company look like that satisfies the inflection speed of Druckenmiller A&D, the margin of safety of Buffett?
It's a fascinating intersection because there is one stock in this 13F filing where their philosophies perfectly align.
Right. The company is BBB Foods, ticker TBBB. They operate a chain of hard discount grocery stores in Mexico called Tiendas 3B.
They have over 3,600 stores. And the engine behind this business is what analysts call a structurally negative working capital model.
That sounds like dry finance jargon, but the mechanism is actually brilliant. Think of it like this.
Let's hear it.
It's like buying a sandwich on your credit card, eating it immediately, getting your paycheck from your boss 2 days later, but you don't actually have to pay off the credit card bill for a month.
I love that.
You have to hold on to that cash and use it for weeks before you ever have to pay for the sandwich you already ate.
That analogy perfectly captures the mechanism. Because Tiendas 3B turns over its inventory incredibly fast. They only carry about 800 essential items, mostly private label brands.
So they collect the cash from the shopper weeks before their supplier contracts require them to pay for the goods.
Exactly. It's an organic cash float engine. They are funding their own growth with their suppliers' money.
Which is the ultimate Buffett metric.
It hits every single point on Warren Buffett's checklist. It provides a consumer necessity. It possesses a low-cost operational moat because their stores are basic, unglamorous, and built in high-density neighborhoods.
Right, keeping overhead low.
And it generates its own cash flow, which means they can expand their footprint without diluting shareholders. Plus, it boasts a very high unit-level return on invested capital.
So the shipbuilder loves it because it's a defensive, cash-printing compounder that can weather an economic storm.
Exactly.
But why does the surfer love it?
Because the wave is currently massive. BBB Foods isn't just sitting still. They are in a hyper-growth phase. They added 593 net new stores in just 12 months.
That is aggressive expansion.
And their revenue surged 39% year over year. Same-store sales grew 20%.
Wow.
For Druckenmiller, this isn't just a safe value stock, it's a rapidly expanding regional retail catalyst. It is the perfect institutional case study of explosive growth meeting fundamental value.
It's the one time the surfer and the shipbuilder look at the same ocean and say, I'll take that.
Beautifully put.
But while they might agree on bottom-up retail in Mexico, Druckenmiller's final strategic pillar utilizes tools that Buffett notoriously avoids.
Yes. We have to examine macro sovereign risk and leverage derivatives.
This is where Druckenmiller's top-down global macro background just dominates the portfolio. In the latest filings, he executed a massive pivot into Latin America.
He quadrupled his stake in YPF. It's up 433% in his portfolio.
Okay, so YPF is Argentina's state-controlled integrated energy company. They sit on the Vaca Muerta shale formation.
Which happens to be one of the largest unconventional oil and gas reserves on the planet. From a purely geological standpoint, the extraction costs are remarkably low.
But let's look at the corporate structure. They are 51% owned by the Argentine state. That structure alone guarantees Buffett stays away.
Oh, without a doubt.
Buffett avoids state-controlled entities and jurisdictions with volatile monetary histories. He views political interference, things like currency controls or domestic price caps on fuel, as totally destructive to a reliable margin of safety.
Druckenmiller, however, is executing a macro arbitrage play. And we should be clear here, we are just reporting on the market mechanics, not taking a stance on the politics.
Right, of course.
But Druckenmiller is reacting directly to the deregulation of the Argentine energy sector under President Javier Milei.
Let's break down the mechanics of that deregulation. How does a policy shift actually change the balance sheet of an oil company?
Historically, YPF was forced to sell its oil domestically at artificially capped prices. This subsidized the local economy but made them miss out on global profits.
Right, leaving money on the table.
Deregulation means YPF can finally align its domestic pump prices with international export prices. It's an immediate profit unlock.
Because of the previous political risk, YPF has been trading at less than 3.5 times enterprise value to EBITDA, meaning you could buy the entire enterprise for just 3.5 years of its core operating earnings.
That is dirt cheap for a company sitting on massive physical shale reserves.
Unbelievably cheap.
Because the state is currently leaning toward economic liberalization and divesting non-core assets to focus purely on shale exports, Druckenmiller sees a deregulatory window to monetize that physical asset. He is trading the policy inflection.
So what does this all mean? If you are making massive macro bets on sovereign policy changes, how do you manage the risk?
It's a great question.
Because Buffett manages risk by holding giant piles of cash. He sits on record-breaking billions in cash, just waiting for a safe pitch.
Right.
But Druckenmiller does something totally different. He uses options.
This is a crucial mechanical distinction in portfolio management. Druckenmiller employs massive options positions rather than heavy cash drag.
Looking at the filing, he holds call options on the RSP, which is the equal weight S&P 500 ETF, stripping out the massive tech bias.
He also has call options on the EWZ, the Brazil ETF, and call options on Amazon.
He uses these exchange-traded derivatives to capture what institutional investors call convex upside.
Exactly.
Translate convex upside for us. What does that actually look like in practice?
It means asymmetrical leverage. If his macroeconomic thesis is correct, say a broad market rally across non-tech stocks or a massive surge in Brazilian equities, those call options will multiply his returns exponentially.
Far beyond what a standard equity position would yield.
Yes.
But it's not just about supercharging the gains, it's about defense, isn't it?
It strictly caps his catastrophic downside. If a macro shock hits, or his thesis on Argentina or Brazil is totally wrong, he only loses the premium he paid for the options.
I see.
He doesn't expose his entire $3 billion capital base to a 40% structural drawdown. So instead of sitting on a dead pile of cash like Buffett does for safety, Druckenmiller uses defined risk options.
To stay fully invested in the thesis while mathematically guaranteeing he can't blow up the portfolio.
Precisely.
So if the market crashes, he doesn't lose the house. He
Right.
only loses the insurance premium he paid to rent the upside. He's buying a life jacket for the surfboard instead of building a heavier boat.
That's the perfect way to summarize it.
If we connect all of this to the bigger picture, looking at this entire $3.38 billion portfolio, what is the ultimate takeaway for the listener trying to navigate their own investments?
The central takeaway is that you don't have to choose between being purely a value compounder or an inflection trader. Both systems clearly work.
Right.
But you absolutely must know why you are buying a specific asset. Are you buying a durable moat with predictable cash flows where patience is your greatest asset? Or are you betting on an impending catalyst where speed and a multiple re-rating are the goal?
Mixing up the two, like buying a speculative inflection story but holding it forever as if it were a permanent moat, is where everyday investors lose their money.
Exactly. You have to know what game you are playing.
And that leaves me with a final thought for everyone listening to mull over today. We've talked about Buffett's unbreakable moats and Druckenmiller's relentless 8-month turnover.
You have?
But what if the ultimate investing strategy of the future isn't choosing between the two? What if the next evolution of wealth building is applying Druckenmiller's ruthless, emotionless turnover discipline to Buffett-style value stocks, selling them the very second their permanent moats show their first microscopic crack?
Now that is a fascinating hybrid approach to consider.
Stop trusting that gravity will always pull the apple to the ground. Maybe it's time to stop waiting for gravity and start surfing. Thanks for joining us on this deep dive. See you next time.